My name is Rob Boff. I work at Bloomberg Intelligence. That's the research arm of Bloomberg. I focus on ESG issues. That's, for those of you not familiar, that's environmental, social, and governance. Specifically, I focus a lot on governance work, which is what I'd like to speak about today. Sorry, this is a little wonky here. So today I'd like to talk briefly about the ESG market, kind of the trends we've seen recently, as well as talk a little bit more about some of the governance research that we've put out. So what is Bloomberg Intelligence? It's almost 300 industry analysts. We focus on industries throughout the world. We have equity specialists, fixed income specialists, strategy people like myself that focus specifically on ESG. You can find our research, for those of you with a Bloomberg terminal, at BIESG Go. So what is important about ESG investing? Well, as we can see here, we've seen quite a bit of acceleration in ESG investing over the last few years. These are specifically ESG ETFs. We've seen an acceleration in both assets under management and the number of funds. And while kind of the traditional exclusionary fund is still the dominant force, that's don't invest in tobacco, guns, you'll see a lot more sophisticated products are coming to market, specifically what we call ESG integration. That's actually, instead of just saying don't do this, it's let's invest in companies that do well at that, as well as some specific strategies like low carbon footprint. And then along with these kind of more sophisticated strategies, you actually need more data. And that's what we have at Bloomberg. We cover about 11,500 companies. Basically, we look at 900 data points. That's anything from carbon footprint to social factors like occupational health and safety to kind of what types of, we've recently added what's called the Gender Equity Index, which has maternity leave, paternity leave type information and a lot of interesting gender specifics as well, which I'll get to in a little bit. And what we have to kind of measure, all right, how good is this data? We have what's called the Bloomberg Disclosure Score. Basically what we expect companies to report, how well are they actually reporting. You'll see environmental and social issues is kind of very low bar, but governance, we actually have quite a bit of data. And you'll see, this is the geographic map. You'll see that's kind of broad-based, and a lot of it has to do with regulation. I mean, there's nothing in SEC filings that you're required to report on your greenhouse gas emissions, but we do need to know who's on your board of directors, kind of a bit of background about them. So we do have a rich amount of governance data, and that lets us do some pretty robust research. So kind of the first thing I'm talking about is unequal voting rights. I mean, we're here in DC. This is kind of the heart of democracy. One share, one vote tends to be the big issue. What you would expect if you own one share in a company, you'd expect to have one vote. But you'll see here that's not always the case. Obviously, some of the older, this is the list of the S&P 500 companies with unequal voting rights. A lot of family-run businesses like Ford, but a lot of kind of the so-called tech unicorns, where you have these kind of strong, you heard about this in the last panel, a lot of strong kind of founder-led companies. And that's where you end up with situations where a company's motto is do no evil, but they'll do everything in their power to suppress shareholder vote. This list is purely in alphabetical order, so I'm not naming names. For those of you not familiar with what alphabet is, you can Google it. But you'll see here actually, so that the common ratio is usually these major voters get 10 to 1. There's a recent IPO that tried to come out recently with 20 to 1 was the original target. That was WeWork. That actually received quite a bit of pushback. And then they tried to redo it with 10 to 1 and ultimately had to pull it. But so we are starting to see investors pushing back on some of these governance issues. But it's still pretty prevalent. I think we just put out a research piece that 8 of the 10 largest IPOs this year have had some kind of dual share structure. And you'll see not only is the dual share structure here, you notice there's some pretty other telltale signs of bad governance practice. So below average level of independent directors, a fair amount of overboarding relative to the indexes, and then ISS, which is one of our data sources for corporate governance ratings. All of these tech companies with dual share classes have very bad risk factors related to their overall corporate governance. So what does this mean as an investor? This conference is the future of investing. So how can I take advantage of this trend? Actually, when these companies go public, there's obviously a bit of a discount involved in that there's not a lot of control as a public shareholder. But we've actually seen over time, by investing in these companies, you can outperform for the most part. As management builds up trust, you kind of realize control is not that big an issue, but you'll also notice companies that have significantly lagged their peers, the minority shares have significantly underperformed, meaning that we'll give you the benefit of the doubt if you earn it, but if you don't earn it, if you're doing a bad job as management, that lack of control is really going to hurt your stock. Likewise, we've seen companies that have done away with the dual share structure, and it's actually increased liquidity. So what can you do as a shareholder? Unfortunately, not a lot. These are recent proxy proposals. They've all failed, and that's not surprising that those in power have the majority vote, so they're probably not going to vote themselves out of power. So what can be done? We've actually seen the indexes take the lead on this. So S&P Dow Jones behind the S&P 500, they've actually said going forward, if you have dual share classes, you're not going to be allowed in their indexes. Why is that important? Well, as we've seen passive ETFs continue to dominate growth in assets under management, that's really pushing corporations to reevaluate and almost play up to get included in these indexes. Our research shows that being included in an index, whenever you're added to one of these indexes, there's a nice performance bump. So companies are really actually starting to think twice. Carlyle Group just came out as they redid their corporate governance with just a single simplified share structure. And because of that, unlike the rest of their private equity peers, they'll be included in the index. Now, was that the motivation? I don't know for sure, but I can ask David Rubenstein backstage. FTSE Russell has a similar rule set in place. All right, moving on. We've also looked at gender diversity. This came up in one of the prior panels. What we've shown is that companies, this is using our factor backtesting tool on the Bloomberg terminal, companies that are in the bottom quintile for women on their boards, they've been the worst performing stock. Now, unfortunately, we can't say companies with the most women have been the best performer, but that's actually a common feature of ESG data, and that it's, at this point, it's more of a factor for risk avoidance than it is for generating alpha, meaning that these may be having low women on your boards, low gender diversity is a sign to maybe stay away, but it doesn't necessarily mean that if you're leading on this, this makes you an attractive candidate. So some of the trends we've seen globally, we've actually seen in Europe, a lot of countries have instituted gender quotas, and California actually came out with a rule that's just taking effect now. And because of this, we've actually seen the Europeans start to take the lead in women on board. However, the downside of that is that while we are seeing a significant increase in the number of women on boards in Europe, we are not seeing that translate to the C-suite. Unfortunately, it seems like, they're bringing women on the boards, but it's not really permeating down to the lower levels, whereas in the US, there's a much more linear relationship that companies that are more forward-thinking on gender diversity promote both at the board level and the C-suite level. Lastly, there's this myth that's called overboarding, or as I call it, overboarding. There's kind of this thought out there that if you're forcing companies to hire more women on boards, ultimately you're just going to see the same woman on the board over and over again. That's actually not the case. The more diversity you have in your boardroom, the less likely you are to see such overboarding, that's board members serving on multiple boards, which kind of can be a major time suck. Actually, the only case where we did see it notable is in the U.S. companies that only have one woman on the board. There is a high prevalence of overboarding, and we attribute that to, unfortunately, tokenism, meaning companies. This was brought up earlier that one of the excuses that's out there is that that you're only going to promote someone who has a CEO experience, and that's kind of what we're seeing with companies that are less forward-thinking on gender diversity. They'll bring one woman on the board. They won't look at a broad range of candidates, and so it tends to be you'll see the same woman serving over and over again on that. Whereas companies that do have multiple women on their boards, they'll bring them from a diverse background. Shareholder activism is another area that we look at. So at Bloomberg Intelligence, we have our proxy tracker tool, so you can actually see all the proposals that have been voted on over the last couple of years. This one in particular is lobbying. You can see who's proposed it, whether it's successful or not successful, and that really lets you know how shareholders are thinking about changing corporations through their vote. What we actually saw this year is a rise in what we call the S in ESG, so social issues, diversity, human rights, pay gap proposal, whereas things like greenhouse gas and sustainability reports are actually a little bit on the decline. And not only that, with diversity, we not only saw an increase in the amount of, we're seeing increase in diversity proposals, but actually more of the votes are increasing, and we actually saw quite a few of them pass this year. Another thing we look at is say on pay result. This is kind of a nice gauge on how shareholders think about corporate compensation, and unhappiness continues to escalate. The level of support continues to decline, and we've seen it take a leg down this year, whereas the number of companies with less than 30% support is on the rise. Lastly, we look at activists. This is another tool we have. You can see which industries are seeing the most amount of shareholder activists coming in, pushing for change on the corporate board. We've actually seen an increase this year in retail, oil and gas is another area, sectors that continue to lag both financially, operationally, and also on, we've increasingly seen ESG being used as a reason for pushing for change at the top. However, what we have noticed is that usually while there's a short-term boost when you change your management team, it's very short-lived. Companies that are lagging, at the end of the day, they tend to be bad companies. It's just a quick turnover at the top. Unfortunately, it doesn't push a major turnaround. Lastly, I want to talk about how do we think about linking the environmental and social to governance factors. One way to do it is to create a sustainability board or a committee on the board that focuses on these issues, whether it's safety, whether it's diversity and inclusion, whether it's philanthropy. And we actually have seen a rise in that. But if you ultimately want to drive change, you need to hit them at the wallet. And unfortunately, we're not seeing too much of an increase in executive compensation linked to ESG factors, which many studies have shown have been kind of the ultimate motivator for pushing for change in corporate issues. Where have we seen this? It's a lot of the materials and energy sector, and a lot of those tend to be safety-related metrics or operational performance areas where there is a significant risk of an environmental or a safety incident. You do want to incentivize these managers to really manage that because the risk can and has in the past been quantified in the form of major fines. What we do like to see is hard targets being set, and unfortunately, there's just not a lot of that yet. You'll either see companies set up, the compensation board compensation committee of the board will look, and ultimately, if we're not happy, we might, make some changes, but we won't tell you how we made those changes. Others have set very broad targets, like we want to get better at greenhouse gas emissions, and you're starting to see BP, for example, and BHP, the miner, have increased the amount of compensation tied to environmental and safety performance, but there's not a ton of transparency in the goals that they are setting. So really the gold standard that we're we'd like to see more of. This, for example, is Chesapeake Energy. You can actually see here how much of compensation is tied to these issues, what is the target, and how has the company actually performed in the last year on this target. And this is ultimate transparency. We think disclosures like this and compensation structures like this are ultimately going to drive significant change. But unfortunately, these are too few and far between. I'll end my speech right there. I have about 10 seconds left. But if you guys are interested in more of this research, my research lives on BI ESG Go. I don't have a book yet, but that's where you can find it, as well as tons of other tools on the environmental and social aspects. We recently put out, in conjunction with Bloomberg Philanthropies, a carbon tracker. You can see how every company's doing on greenhouse gas emissions, what targets they've set, and read our research on how they're looking to tackle the challenge of climate change. I'll end right here.